Hello.
All right, thank you. So we'll go ahead and get started. Just bear with me momentarily. All right, welcome everyone. My name is Renee Edwards. I'm the program director for Fairfax County Public Library. Everyone is muted, and we ask that you keep your videos off until the Q&A portion of the presentation. Ms. Celia will speak for about 30-40 minutes, and then we'll open it up for questions. You may either ask them or type them in the chat box. We are recording this event, and I will make it available through our library YouTube website. So please allow me to introduce our speaker. Ms. Lynne Celia has a bachelor's degree in information technology and an MBA in finance and investing from George Washington University. Her extreme success in her first career as a business owner and consultant in information technology allowed her the time and opportunity to pursue her passion in finance in order to make a difference in people's lives. So we are happy she is here today to discuss the topic, investing for retirement in good times and bad. Welcome and thank you, Lynne.
Well, thank you, Renee. I'm very happy to be here and welcome everybody that's on the call. Let's get started. First, I have to give a disclosure, which really all this says is I'm providing education and I'm not giving custom, individualized, tailored advice to you, the people on the call. All right, because I am doing a bit of virtual advising these days, so we have to be really clear when we're online or in person as to what we're doing, educating versus advising. I'm really happy and delighted to have done, this will be my fourth workshop here with Renee and for the Fairfax County Public Library System. We started back in April with, when COVID was clearly in full throttle, and we talked about how to protect your investments. We talked about financial wellness, how to reduce money stress during COVID. And then last month was really, a check-in. Where were we with COVID? Where were we with the markets? And it was good. We basically have been in touch now once a month. So here we are today, and we're really going to talk about investing. And, this really applies to everybody, not just for retirement, okay? But investing in good times and bad times, all right? And so with that, and we may have one next week. I don't know, Renee, if we're based on how well today goes, maybe we'll do a few more in the months to come, but stay tuned. All right, let's get started. So we're going to talk about, I'm going to tell you a little bit about me. Renee, she's always so gracious in her introductions, but I'll tell you a little more about my background. And then I do want to review where we are with COVID and the markets. And then we're going to get into the meat of the presentation. And in order to really talk about the mistakes we make and the do's and don'ts, it occurred to me that, well, we really have to talk about what type of investor we are, because a rule or a do, a don't, a mistake, it really changes, based on what type of investor you are. And so then we'll wrap up, and we'll end it with a Q&A. Okay, so about me, I'm not sure why I always need to share with people that I was born and raised in South New Jersey, but and then I always like to say, well, don't hold that against me. But I grew up in an extremely blue-collar neighborhood, and not really thinking too much about money and investing. But lo and behold, when I went to college, you know, I did something really, really crazy. And I didn't know where it came from, but I took my first student loan. It was a Pell Grant, and you didn't have to, you know, you didn't have to write the check directly to the college for tuition. You could do what you wanted with the money, you know, room and board. Well, I basically took my $2,500 and I invested it. And I did that, and then I went to work as a waitress, or now we call ourselves servers. But I went to work and made up the difference. And because, you know, how I grew up, I mean, seeing a check for $2,500 was, I mean, it could have been $1 million. I had the same reaction. This is a ton of money, and why don't I just invest it? And after college, so when I graduated college, I came to work in Northern Virginia. You know, with a degree in computer science, I went to work, and at night, I pursued my MBA in finance and investing, and I got that from GW. I owned my own tech company for 20 years, and you know, did all of the investing for my company and for myself. And about 15 years ago, I woke up one day and said, you know, I'm gonna pivot. I'm gonna pivot, and I'm gonna pursue my passions in life, my faith, my family, and finance. And that's when I had children, and when I became a financial advisor and financial planner. I've been through a lot of adversity. I guess you could, you know, you could say, I mean, everybody goes through, I think, personal adversity, but professionally, you know, I've just been through a lot, being a business owner, and you know, being in the markets for so many years. I've had a lot of adversity, and I try to be stronger, smarter, and more resilient each time I go through it. Now I'm doing workshops like this and more education, focusing on my personal overall wellness and helping you become educated and informed and financially and overall healthy. So given that I shared with you, now this will tell you exactly how old I am. I probably want to, I might revise this at some point, but I've been investing for 40 years, right? I was a freshman in college in 1980. And I took that $2,500 and whammo bammo, I put it into the market. And so, you know, here we have the annualized return of the market. This bar graph, you can see that between 1980 and present, you know, we had mostly positive returns over zero, right? But I have been fully invested and in the market either as a technology business owner or as a financial advisor, right? And planner. But these are the big market declines. And, you know, we've got like Black Monday. We have, goodness, this was a lot right here. The technology bubble burst. We had 9/11. This is the Great Recession. And over here, we've got, you know, we've got COVID. So, and this is a bar graph. We don't usually look at the markets like this, but I have this chart because green than I have red. And I show this chart when I'm talking about they react. Is dramatic down. Here is just, let me go, if I can go back. No, and right here, I'll go back. This one right here is just a typical bar graph that we see. And I want to be redundant, but I've been investing for a long time, and I think that's important to attend these types of seminars because I think with the internet, we can become pretty quickly educated about a lot things, but it's not until you live through it and you're losing your own money when you really realize the mistakes you've made and how to correct them. And so I would say that I've learned a lot in the beginning that I was able to apply in life career. And good job sharing that with you. All right, let's talk about COVID. You know, when we met last month, when we had our workshop last month, we were entering phase 2, where we were, you know, to open up the economy. And I shared with everybody, nervous about that because I did not see the decline in cases that I had hoped we had. And it was really just a cautionary point. And so, you know, here's where we were last month, right, when we had our workshop. Now here we are today, and I feel very good about that. I don't feel like cautioning anybody. I can't speak for the rest of the country and the states opening up that opened up way ahead of time. But I do know, you know, as a Virginian, I'm happy with how we're managing it. And we do see a dramatic reduction in the COVID cases from 1 month ago. Okay. Clearly, we're in a downward trend based on the graph and the numbers. So ahead of us with respect to COVID, you know, July 1st, we're going to enter phase 3. The cases and the hospitalizations are down, the testing, we're doing a lot more testing, and the positive tests are coming back at 6.4%. It used to be 10%. And I think that the percentage would be lower, but we're doing more testing, right? There's enough protective equipment for the hospitals. Everybody has masks. I even have mask envy. I look at other people's masks and wish that I had them. So that's always a fun kind of positive thing, you know, when you think things are getting better. The changes we're going to see, I'm not going to go into detail because you can certainly pull these up online, but yes, we're on our way back to normal, okay? Or the new normal, which I think is what we call it, okay? Let's do a quick market review from where we were. So on the last workshop, we were looking at the effects of COVID, you know, that infamous day when the market dropped 38%. As of May 27th, a month ago, we had made a pretty remarkable recovery. The market was down 38% as a result of COVID, but it was up a month later, 35%, which roughly was about, you know, got us about halfway there. Okay, when you go down 38%, it's not 38% that will get you back, right? It's more like double that. So today, we're going to look at, well, where are we from a month ago? So a month ago, we were basically at 24,500, which is about right here where my arrow is. Today, I took this off. This is actually as of close of market yesterday. We're up 500 points. That is what we call a sideways correction. So you see, we were here 2 months ago. We had a 30 to 40% increase over a month. And now a month later, we've kind of leveled off. Okay. And if I take a closer look, This is kind of a zoom in now on the last month. You can see where we were a month ago and where we are today. And that is what we call sideways. And I interpret that in light of COVID as holding steady. It's going to go up, but it's going to go down, but it's a very short time frame. And to hold steady for 1 month, I say that's a very positive indication. Not that the markets are going to go up, but that the markets are going to be steady. Okay. All right. Let's get into the topic here, investing in good times and bad. If you think about the chart that I had just shown you with the bar graphs going up and down, there's a whole lot more green than there are red. That really should say to us, our investing actions should be no different in good times and bad. And at the end of this workshop, I hope you'll see that message come through. And I think it's really easy to say and hard to do. To not let fear and emotion, get in the way. But there really should not be a distinction between how we invest in good times and bad times. And I'm not necessarily saying everything we do is a buy and hold strategy. But I am saying that there's a few fundamental things that we must hold constant. All right. Now, to talk about the do's and the don'ts and the mistakes, I think we've got to take a look at what kind of investor are you? Now, and not everybody's an investor. Maybe you're on the workshop today because you don't invest and you've got all of your money sitting in a money market, or CDs or something like that. That's what I'm going to call a non-investor, for lack of a better term. Then, of course, there's the do-it-yourself investor. The person that thinks, yeah, you know what, I can do this on my own. I don't need help. And I think that's never been more possible than today, because the ability to educate ourselves with a few keywords and a click of the mouse on the internet is absolutely amazing. Being your own investor 20 years ago was much harder, even 10 years ago. And I think the future, we'll just have robots investing for us, with artificial intelligence and machine learning. And then, of course, the third type is you have an investor. You have an advisor. So that makes you an investor, but you have outsourced it. You have trusted your money with another professional in financial services. So these are the three types that we're going to talk about. All right, so let's talk about the do's and the don'ts. Now, I will say that the do's and the don'ts are really for all investor profiles. It's more when we talk about the mistakes, I think, when we have to delineate more, or we have to go into a little more detail across the investor profiles. But basically, for all investor profiles, I guess I should say the second two, not the person that doesn't invest, but the person that does invest either on their own or with an advisor should have their advisor do these things too. And if your advisor doesn't do these things, then you've got cause for concern. But first and foremost, you really want to diversify your investments to reduce risk and increase returns. And I'm going to talk about these a little more. You want to allocate your assets across many industries. And you want to invest in all of the asset classes for equity. The large cap, the blend, the value, the small cap, mid cap, international, right? And emerging markets. So you basically have your domestic equities, you've got your international equities, and you have emerging markets, right? more the underdeveloped or undeveloped nations, right? And within that, you have large cap, mid cap, small cap. So there's a lot to diversification and asset allocation. And I like to just give you a visual here that there's 11 sectors in our industrialized nation, right? Information technology, healthcare, energy, telecom, consumer staples, consumer discretionary, real estate, industrial, materials, and utilities. When we invest, we really want to take a look at all of these industries and try to figure out where are they going. This is some high level, fundamental, top down, understanding of where are we going in these industries. And even beneath them, there are sectors and subsectors. So, it goes on and on and on. But at a very high level, you really want to be cognizant of what you're invested in, and do you have several of these industries? You don't have to invest over all of these industries, but you should at least hit, I would say, anywhere from 2 to 5. All right, we'd already talked about diversifying across domestic, international, and emerging markets, right? And, like asset allocation, this is really aimed at reducing risk. So if you're doing this on your own, or your advisor is doing it for you, you should be able to speak with your advisor intelligently and know enough to ask the questions, hey, am I diversified, right? And hey, what is my asset allocation? And, if you ask the right questions, you also want to be knowledgeable to understand the answers that come back. So asset allocation is dividing your money up across investment categories. You don't want all your money in stocks. That's incredibly risky. You don't want it all in bonds, right? Right now, our 10-year treasury, government treasury bond, is making 1.4%. So that's not, I don't even think that's going to keep pace with inflation. So you really want to mix and match these, and it is truly the primary way that you can achieve your financial goals with the appropriate level of risk and return over your individual time frame for investing. And I believe, if we have to pick one, asset allocation is probably the most significant thing you can do, where you can really earn the return that is commensurate with the risk that you're taking, right? So I just dive into those two in a little more detail because they're extremely important, whether you're investing on your own or somebody else is doing it for you, and you need to be able to communicate with that person. So some of the other do's, well, I've invested, when I had my tech company, I actually worked with other financial advisors. And back then it was, you were always it was like $500 to make one stock trade. Now it's free. It's free to make a stock trade. So, trying to sum up where we are today, I would say you really don't want to pay you don't want to pay high expenses, whether you're doing it yourself or your advisor is doing it for you, okay? You want to buy passive funds, okay? Index funds, ETFs. And if you have an IRA or 401k available to you, really do want to put money into those accounts, okay? And you want to be the most tax efficient. You want to be most tax efficient as possible. And I'll even go so far as to say that if you have an IRA or a 401k that is tax deferred, I believe that taxes will go up. We are in the lowest tax rate environment of our nation's history. And I guess because of my age, I can remember when tax rates were 60, 70% in the 1970s and early 80s. You know, and when I look back at it, it's probably why I invested the money, because the interest rates and the returns were so high back in, you could get into some very safe investments back in the early 80s and make great returns. But you can't do that today because we have the lowest tax rates and the lowest interest rates in our nation's history. So, you know, those are the do's. What are the don'ts? Again, you know, for the investor profiles of doing it yourself or having an advisor. I see so many people make this mistake. They buy mutual funds in brokerage accounts, not in taxable accounts, when you should only buy them in tax deferred or tax free or tax advantage, we call them the Roth. Because mutual funds, you can buy a mutual fund and hold on to it forever, but every year you're going to get a 1099 and you're going to be taxed on the internal capital gains that money manager who's managing that mutual fund, you're going to pay taxes even though you personally have not incurred the gain until you sell it. And it really is a double wham, because in 10 years, you know, you're going to pay taxes every year. If your money manager is making money by doing all of these internal trades, you're going to pay taxes. And then when you sell it 10 years later, and hopefully for a gain, you're going to pay taxes again. Be careful with these mutual funds. Only buy them in your retirement accounts. And you know, when you're looking at your asset classes, you know, you can't be all in classes that have low returns or high levels of risk that are, you know, a high level of risk should be associated with a high level of return. So do not invest in something that is high risk, low return. It's common sense, but you know, if you don't do it for a living, you got to be really, really careful, because I do believe that with the internet, we can actually feel educated when we're not really educated, and we can make our mistakes quicker and bigger. So you really want to take time and make sure that for the return that you want or the return that you get, that the risk is commensurate with the return. We call that the risk-reward ratio, right? More return, more reward if you take more risk, but you can also lose more. The third don't. I am a passive investor. I really don't try to beat the market unless I'm trading options, and that's a really sophisticated thing that I don't do for clients, right? I don't really, you know, there's hedge fund managers and people out there that do it, and that's what I call active management. Otherwise, I recommend, you know, stay with your indexes and your ETFs, and do not speculate, okay? Do not speculate. Speculating is, you're at a dinner party and somebody tells you, you know, there's this really great stock, there's this really great company, blah, 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 you know, and you go home and you put money into that company based on what somebody said to you, or, you know, over drinks. Yeah, that's speculation. That's pure speculation. And don't do it. And don't get snookered. I love that technical term. Don't get snookered into thinking you have found a stock market guru. Because if you have an advisor that says they can beat the market, I suggest you fire them and you go find somebody else. Because if they can truly beat the market, they would not be sitting in front of you, right? They would be off running some multi-billion-dollar hedge fund, okay? Obviously, if you're a do-it-yourselfer, you really want to sort of go with the market and stay invested. But we'll get to that. But definitely, please don't let somebody tell you that they can predict where the market is going. Because I guarantee you, I've been doing this for 40 years, and I have made the mistakes of following people's advice. And for every person that says it's going up, there's a person that says it's going down. And that is the truth. All right. Let's talk about the mistakes. The top 100, no, the top 8 mistakes that you can make when you're investing for your retirement or for anything for that matter, and how we can avoid them. All right. So here you're going to see I do split us up into our categories: the non-investor, the do-it-yourselfer, and I have an advisor. So mistake number 1, not understanding the impact of taxes and inflation on your nest egg. You know, the non-investor who has their money in cash in the money market may feel pretty good, you know, when the market drops because of COVID. But that person does not understand that over time, they're going to be traveling backwards. Taxation, interest rates, inflation, they're all going to reduce the purchasing power of your cash. And the CD rates, well, they're very low, you know. So mistake number 1, if you're in cash, you've really got to take a hard look at that. I think everybody should have cash and not be all in the market, but not 100%. All right, do-it-yourselfer, obviously you have to understand what you're doing and how significant it is, right? You've got to be educated and informed. If you have an advisor, mistake number 1 is not understanding what your advisor is saying and what your advisor is doing. I rest assured, everybody that I have talked to comes into my office that I don't know. And I say, well, what brings you in? Why are you here? How are you invested? I say, well, I have an advisor. Okay, what are you invested in? I don't know. Well, can you just describe it? Like, are you in stocks or bonds or, yeah, I don't know. Okay. So again, why I'm focused on education is just because you have an advisor, you need to be educated somewhere between a do-it-yourselfer and the advisor themselves. Like you need to understand conceptually what they're doing and why. Okay, that's mistake number 1. Mistake number 2, falling in love with your money, your cash money, the non-investor. I love my cash. Well, if you have 100% cash and you're in love with it, you've got to have so much of it to never invest. Or you have to be very old to be all in cash. Falling in love with a company. I see so many people that have too much money in the company that they work for. And all I have to say is Enron. Okay? I know we don't imagine it, but it's too risky. You're basically taking too great of a chance. If you fall in love with a company and you stay invested in that company forever, don't do it. And don't fall in love with your advisor if you have one. It can create all sorts of problems, but I think the biggest problem is it becomes hard to fire your advisor, right? I think over a period of years, absolutely. If your advisor is like, gets to know you and becomes sort of like a family member, great. But, you know, they've got to prove themselves before you let them into the inner circle. Okay? All right. Because this is your money we're talking about. Mistake 3, a lack of patience. With the do-it-yourself, it's not applicable for the non-investor, but with a do-it-yourselfer, you have to be patient. If you're going to educate yourself and make these informed decisions, you've got to give them time. And you have to give your advisor time. So if you have an advisor and, you know, in that first, you can't be ringing, they're blowing up their phone when the market, you know, goes down a little bit. Investing is a long-term endeavor. It is a long-term relationship. And that's why in good times and bad, you know, it really shouldn't matter. Okay? Be patient. Investment turnover, mistake 4. You know, what is this mistake for a do-it-yourselfer? Well, I say see mistake number 3, which says be patient. Do not buy and sell. Do not buy and sell quickly. You have to stay invested. If you have an advisor and they're making a ton of changes, you really need to educate yourself on the cost of each transaction. And, you know, I think that you've really got to think of the opportunity cost. And that's a big conversation. Opportunity cost is, well, if I stay in the market and the market tanks, what opportunities have I missed that might be doing better? If you jump out of the market too soon, the opportunity cost is when the market rebounds, you know, and you're still on the sidelines in cash, you're not going to reap the benefits, right? So opportunity cost, knowing the cost of the transaction and what you could have done differently, okay? This is a huge one. And this has to go with my thing about trying to be a guru to people and trying to forecast where the market's going. You know, a lot of people expect advisors to know, oh, you know, to just be able to spew what the Dow is today and what percent return and what's the monthly year to date and what's the monthly year to date and life to date, you know, returns. And I've never done that because it's too much information. You know, you can't time the market. You certainly, obviously, you're going to know that the market's down 30% because of COVID. But because COVID, let me step aside and explain. COVID is, in terms of the markets, very emotional. We're dealing with people's health, which takes precedent over people's money. Different from the financial crisis in 2008, which was really a crisis in the financial markets. And, you know, but the primary in 2008 was the markets because of the subprime lending crisis and people not being educated and informed about loans they were taking and you know, Wall Street and banks being greedy. Primary was the market and secondary was health. But this 2020 COVID decline is health related and fear-based and emotional-based. And you saw in the beginning, just as quickly as the market dropped, within a month, it recovered, you know, almost half of its, you know, of its decline. So quick to go down, but how quickly to come up has a lot to do with what's driving it. You can't time the market. Really, really impossible to do. I had done some courses just before the virus hit. And when I followed up with my students, some of which who wanted to work with me to make some changes, 9 out of 10, 18 out of 20, it was, everybody wanted, let me wait. I want to get back to my starting point. Now, in 2001, the market declined 3 years in a row. You would have been waiting a very, very, very long time. In 2008, it came back quicker. And this one, I believe it's going to come back, within, I would say 12 to 18 months. But there's no crystal ball, right? And I don't want you to take that as advice and go run and make some changes. But waiting to break even can really hurt you. So I always say, cut your losses at 20% on each investment. Okay, you cannot be emotional about it. This is my personal and an industry standard that I happen to adopt for myself and for my clients. Understand really what it takes to break even if you're a do-it-yourselfer, and cut your losses. And for an advisor, I say, go back and go see mistake number 5, be patient with your advisor and really focus on understanding what they're doing and why, right? Okay. Failing to diversify. We talked about this up in the do's and don'ts. So for the do-it-yourselfer out there, I say you've got to educate, 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 educate. Never put all of your eggs in one basket. Don't put them all in one sector. Don't put them all in one company. Don't put them all in stocks. Okay? Educate yourself on what it is to diversify and asset allocate, and never put, and even if you want to continue to always manage your own investments, you should always check in with a financial consultant. All right? Because I'll give you a very real example. I was meeting with a woman who is a do-it-yourselfer, and she's retired. And we were talking about her retirement planning. And she had all of these spreadsheets and models and things, and I was very impressed. But the more we talked, I realized that she was calculating her RMD incorrectly. The required minimum distribution. That's the age. It used to be 70 and now it's 72. But that is the age at which Uncle Sam says, hey, if you have a 401k or a traditional IRA and you haven't taken any money, you have to take money because I want my taxes back, Uncle Sam says, and I'm not going to wait forever. So at 72, you have to take RMDs. So she's in her mid-60s and she's calculating her RMDs in her planning, but her RMD calculation was completely wrong. So is the problem that she's a do-it-yourselfer, or is the problem that she had the model, but down in the weeds, she wasn't calculating a very significant figure correctly? So beware. By checking in with me, even though I'm not her technically her asset advisor, I'm more of a consultant, I was able to uncover several things like that and get her back on track. So I recommend even do-it-yourselfers always check in with a financial services, with a professional. If you have an advisor, you've got to understand, hey, are you diversifying? Now, be clear. Some advisors don't manage all of your money. They only manage a portion of it. they need to know what you have elsewhere, even if it's not with them, so that they can see if you're diversified. You don't have to be diversified with the advisor, but if that advisor is managing all of your money, yes, you have to be diversified. But if you, if you have, keep it simple. Let's say you have $200,000 and they have 100,000, and they're managing 100,000. Well, are they just managing the stocks for you? And where's the other 100,000? Is it in cash? Are you on the side speculating with it in highly risky, penny stocks? So always be open. Always be open. And understand what diversification is so that you can make sure you're talking with your advisor about it. Okay, this is the biggie, because whether you're doing it yourself or the advisor, or you're calling your advisor and screaming into the phone, sell, it's emotion. And so it's actually emotion for everybody. So I've got all my money in cash. I don't invest. There's a reason I'm not investing. What is that reason? Is it emotional, fear, educational? I don't know what I'm doing, but for non-investors, I say, you got to get off the sidelines. You got to get into the market in a very thoughtful, educated way. Do it yourself first. You've got to leave fear and greed at the door, right? You just, it's the only way I think you can be successful, right? Just as important, you're sitting on a stock or a fund or an ETF and it's going up, 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 up. You tend to not want to sell it. It's a little bit like greed, right? Oh no, this is going to go up higher. Well, it might and it might not. So there are strategies for getting into the market and out of the market safely. If you have an advisor, keep the relationship about business and returns. Give them time. Be patient with them, right? Be patient with them. Don't let your emotions get in the way of your advisor doing their job. Okay. How to avoid these mistakes? Well, this is so simple, and I feel like I just, beat this to death, but you really need a plan. Non-investor, meet with a professional. Start educating yourself. Figure out whether you want to be a do-it-yourselfer or you want to have an advisor. But for these two categories, you definitely need a plan of action, and you need to stick to it. Automatic pilot. Get a plan and put it on automatic pilot. Whether you're doing investing for yourself or you have an advisor. If you have to satisfy that urge to speculate, which to me is like gambling, take a little chunk of money and keep it on the side to buy lottery tickets or invest in penny stocks or the company that you talked about with a friend the night before, right? But that should not be part of your portfolio, okay? It should not be part of your nest egg that you're using to fund college or retire on, okay? And the fund money can apply even if you have an investor. I had plenty of clients that I manage their money, but they have their money that they play with, and that's a healthy relationship right there, okay? All right, the bottom line, bottom line as we wrap this up is, if you tuned in today because you're sitting on the sidelines with a ton of cash, or you just have never invested, the way to any semblance of financial security, unless you are filthy rich, gobs of money, the way to financial security, wellness, whatever that definition is for you, is to invest, right? One step at a time, one day at a time. If you're a do-it-yourselfer and you've come up with that plan, sanity checked it with a financial consultant, put it on autopilot. And once a year, twice a year, check in with a person that does it for a living. If you have an advisor, you must educate yourself enough to know the right questions to ask, to be able to understand the answers and when you should ask them. Do not, ask your advisor to sell everything when the market tanks. Your advisor should know in your plan that if the market corrects, and that's anything greater than a 10% decline, part of your plan is, what do you do? So I'm not saying that you never sell in a market decline. I'm actually saying, what does your plan say? Have you thought about it? All right. If your time horizon is long and you can just let it go until you see more green on that bar chart that I was showing you and less red, stay the course. But if you have some more immediate goals, I would say anything less than 7 years, whether it's retirement or college funding, that market goes down 10 or 20%. You probably want to look at your plan and see, do you jump out and limit your loss, because you have no idea if the market's going to continue to go up or keep going down. And that's where we are right now. We've gone sideways for a month, and we'll keep our eye on it. And next month we'll see, are we still sideways? Have we edged higher? Have we edged lower? But at the end of the day, what does your plan say? All right, I have a Lynneism. This is my own saying, and I love to say it. Rest assured, if you do not make informed, educated decisions about your money, someone else will be happy to decide for you. You don't want to give anybody that much control, all right? Not even your spouse, who, if you're married and you've got someone that does all the finance for you, and if you don't understand a thing, you're in trouble. You want to be educated, at least so that you can ask the right questions and understand the answers. All right, you can contact me. Here's my email. Don't hesitate to reach out. I have a website. You could subscribe. You could schedule a telephone call with me. This workshop and some of the ones that I've done are recorded and on there to be replayed at your convenience. And stay tuned. Maybe we'll be back next month. I'll talk with Renee about that. Okay, I think, we're going to open it up for questions now. We've got about 10 minutes left. But I always tell people, stay calm, stay invested, and stay well. All right, thank you very much, everybody. And I'm happy to take questions now.
All right, thank you, everybody. So you have the ability to unmute yourself if you would like to ask any questions of Lynne.
Hi, Celia. Thank you so much for this very informative workshop, and I am really excited to go back and look at the recorded webinars. My question to you is, what do you think of these sites like Acorns and Stash that have popped up for people to invest there?
Yeah, great question. I'll tell you, don't laugh at me. I just put my website up during COVID. I was sitting home and I was like, maybe I'll finally build a website. So it's not yet a plethora of blogs and videos, but believe it or not, I actually have done a personal study, and I joined Robinhood, Acorns, and Stash.
Okay. I didn't know about Robinhood, but go ahead.
Yeah, and I thought to myself, wow, I should really do a little blog or something, because I'm a financial advisor And some of them were easy and some of them were hard, and some of them you couldn't get your money for, like if you tried to transfer money, you know, so, you know, like it would take like 4 days to get your money, and nobody wants to wait 4 days for money to go into an account or out of an account. I don't like that. So if I'm trying to, you know, so I have a lot to say. I can definitely talk with you offline.
Okay.
Because you know, I have my findings written down. I can tell you they are things like, well, if you want to do this, you have to use stash, because the other two either don't do it or they have it, but it's not that good, right?
Okay.
So I've sort of gone through it and said, like honestly, you can actually go on and trade options in some of these little snappy mobile apps, which is a very sophisticated thing to do, and that's a double-edged sword. So I hate to not be able to answer your question, but I can tell you I have hands-on with all three, and just like I work with Vanguard and Fidelity, I work with robo-advisors and like Betterment, and you know, and I do these things because it's a passion of mine, right? I'm so weird. But truly, right? It's like, well, yeah, and so that I can help others. And if you really want to start being, if you're a do-it-yourselfer, which is what those apps are for, there's some things you should know.
Okay. Do you mind if I reach out to you?
Yeah, no, just go
Okay.
go on my website, shoot me an email, or go on my website.
I
And
would appreciate that. Thank you so much.
yeah, absolutely, absolutely. Anybody else? Honestly, any question, if it comes to mind after, you know, you can reach out. I'm happy to talk with you.
Lynn, we had one question in the chat. What type of questions should you ask financial planners?
Well, financial planner or financial advisor. So there is a distinction.
Donna said planner.
Okay. Well, excellent.
Oh, she changed it. She changed it to advisor.
See?
Thank you, Donna.
Aren't I intuitive? Because can't you tell that I've had that question a million times? And,
yes.
And I start answering it one way, and I find that they really meant advisor. And I'm going to tell you this, Donna. Every advisor calls themselves a planner, but you're not really a planner unless you're a CFP. And that's not a pat on my back. It's a really difficult credential. And, you know, it's to be expected. It's difficult to get. A planner, a true planner, has the CFP certification, and you'll see it after their name. A lot of advisors say they're planners, but they're not. So the companies they work for give them planning software, and that makes them a planner. It actually doesn't make them a planner. So first, understand the distinction. Second, questions to ask an advisor, there's a million, and I'm actually going to create short videos. Like not videos, they're probably just like little 2-minute blog, I don't know. I haven't figured it all out, but the questions are, I mean, you know, Renee, maybe we can actually do a workshop on that. It's very niche, but you could spend an hour on what to ask an advisor. So, and what's your experience investing, right? I had somebody ask me, do you have over $1 million? And I answered them honestly. And the answer is yes. I don't think $1 million is a ton of money these days. I mean, I've been investing since I was 18. So if I didn't have it, she said, well, yeah, if you didn't have it and you've been investing for 40 years, I would really not want you as my advisor. So yes, you can ask that individual, well, what are you invested in? Are you invested in the things that you tell me to invest in? What's your philosophy? What's your experience? What are your fees? What do you do if the market corrects? Are you a planner? Are you a CFP? What are your credentials? Do a broker check on them. You know, not every bad mark on a broker check is a bad thing. And I'll tell you personally, I filed for bankruptcy because I cared for my father with dementia for 5 years. And it cost, I can't even begin to tell you. I mean, he didn't have long-term care insurance, and it cost hundreds of thousands of dollars. And I paid for it. And I thank God that I had the money to pay for it. And it did take a chunk out of my, you know, my financial future. But I'm thankful that I had the money to pay for his bills. But when he passed, I did file Chapter 11 to reorganize and liquidate things in order to pay the medical bills. So you also have, so what I'm trying to say here and why I share that is, if you were to do a broker check on me, you would see filed Chapter 11 bankruptcy, but you wouldn't know the story behind it. And quite honestly, everybody I know with money has filed bankruptcy at some point in their lives. It's a business strategy more than you know, our average American who's living paycheck to paycheck. They are not the people that file bankruptcy, you know, because it's a sophisticated strategy. It really is. And it affects you for the rest of your life. I still can't get a credit card, but I don't care because I don't really like credit cards. So Donna, call me if you want to talk some more, and there's tons of information. I will tell you this, tons of really good information, because interviewing an advisor, I don't believe is something you can make a mistake on. So you can query the questions on the internet. You know, just go to Google. What questions do I ask when I'm selecting an advisor? And you'll see everything that I just said, right? You'll see it all. The mistake you can make is not understanding the answers. So that's where I think we get ourselves into trouble. And that's where you've got to have some education, or you can actually have somebody interview the advisor for you. And I know that's out there and it's lofty, but the way we manage our money these days, everything about it is changing and is different. And if you're going to trust somebody with your money, you really need to be smart about how you pick them and how you communicate with them in an ongoing relationship. It's a two-way street. If if your advisor is not communicating with you, that sends a message as well. So I probably went around the block 3 times on that question and divulged a lot of information, but I'm pretty much an open book when it comes to educating, because I find that it's only when you open up and tell people what you've been through, you know, that you find that we're all connected in one way, shape, or form. So.
All right, thank you so much, Lynn, for that wonderful discussion. I think we have the next program for your series.
So Donna,
you get the best ideas from people. That's why I love programming and talking to people, because you don't have to create it; they create it for you.
You're welcome.
Thank you.
I'm going to also do the difference between advising and planning.
Yeah, this is great. Well, thank
Okay.
you, Lynn. Thank you, everyone, for participating. I will email everyone who registered for this event the video link, because we will upload it. So thank you so much, and have a wonderful rest of the day.
All right. Stay well, everybody. Take care.
Lynn, hang on.
All right.
Thank you very much. Bye-bye.
Bye-bye.